Richard Harris of Port Shelter Investment Management joins us right now on the show with his thoughts. Richard, good having you. Thanks for joining in. A quick sense, the markets were anticipating some announcements. Donald Trump absent in the press conference as well. That's brought the futures down. Would you reckon that if some announcements come in, there could be a bit of a bottoming out process, or is it difficult to call right now?
Well, I think the problem is that the U.S. authorities, certainly the White House, seems to be at sixes and sevens. They don't really seem to have a particular policy, don't seem to know what they're doing. They seem to be fighting a rearguard action. And Trump's tweets are clearly not helping because, you know, on the one hand, they seem bullish. On the other hand, there seems to be no action following that up. So I think the sentiment coming out of the White House is rather poor. In terms of where the markets are going, you know, we had a rebound yesterday, but I think today is going to be very important to see whether the markets are going to bottom out, maybe, you know, with a 2% fall or something like that, which we're seeing in the futures at the moment, or whether they will see a much bigger fall today. I think the odds are probably still that the markets are going to go down, but we could see maybe a bottoming out midweek, just for everybody to catch a breath.
Richard, this is also a time where, you know, you're having contradictions within. So on one hand, just a few weeks ago, you know, Stephen Mnuchin said that this is not like the financial crisis, and therefore to expect a big economic stimulus, this is this will play out in its own course of time. This is a time-bound event and therefore may not warrant such big actions. And then you have Donald Trump coming in and saying that they're going to looking at zero payroll tax. So do you feel that this, as well as the fact that even if such a measure is put into place, it will take time to play out, and by the time it's come into effect, the market and the uncertainty there will already play out its course?
Well, you know, this is an evolving process, and it's going to be difficult to hold policymakers to things that they were saying a little while ago. I mean, policymakers are in a difficult position. If it's a serious event, on the one hand, they must act seriously and decisively and boldly. On the other hand, if they do that, they're terrified that the general population is going to be spooked and take fright, especially the markets. So the Fed a couple of weeks ago cut rates significantly by 0.5%, thinking they were bold and dominant, and all they did was spook the markets. So it's a very difficult situation for policymakers. I think what is also going to be, it's clear that governments are going to come in with a lot of fiscal support. That, of course, is going to add to the debt burdens, which have to be unwound sometime at some point. So that's difficult. But I think that governments will come in and provide liquidity support to try and avoid the kind of credit crash that we did in 2008. So I have some sympathy for policymakers and their pronouncements, but I think, you know, we have to see what they do rather than what they say.
Richard, what is the expectation then from the Fed on the 18th of March, and where does that leave equity market investors?
Well, you know, everybody's been saying, oh, interest rates have to be cut, but the last cut did no good at all. Indeed, it spooked the markets, and further cuts, you know, are only going to mean that the Fed has got less ammunition in the future. The markets seem to be convinced that the Fed is definitely going to cut. I'm not so sure. I think that you know, there's still a possibility for them to turn around and say, well, we're holding our powder at the moment because the government is doing stuff. So I'm not so sure the markets would be terribly concerned by the Fed not cutting yet again, because I think it's generally understood that cutting interest rates is not going to solve this problem.
Yep. It's more of a demand and supply shock, and fall in interest rates. I don't know how much more it can do to address that issue. Thanks very much, Richard, for joining us this morning.
Pleasure.